A lot of people overcomplicate investing. They'll spend a lot of time creating these spreadsheet models that try to predict whether or not an investment's going to go up or it's going to go down. And what ends up happening is they spend so much time on these spreadsheets and they end up not even beating the market the majority of the time. So there was actually a new report that found that almost 80% of active fund managers are falling behind the major indexes. Now, what if I told you that there were only 3 investments that you needed to make, and that these investments held together would not underperform the market, and it's so dead simple that anybody can actually execute on it? Instead of trying to predict which stocks are going to perform well, we're going to invest in 3 broad-based index funds that cover both the stock and the bond market. The goal of this strategy is to provide you a well-diversified portfolio as well as a good potential for returns. Now, this is famously known as the 3-fund portfolio, and today we're going to go over the benefits and how to set it up. The 3-fund portfolio has been popularized by the Bogleheads community, which is named after John Bogle, the creator of Vanguard, and these Bogleheads are investing enthusiasts who want a simple approach to investing for the long term with low costs and diversification. And as its name implies, you really only need 3 funds to make this work. They consist of basic asset classes like the US Stock Market Index Fund, the Total International Stock Market Index Fund, and a Bond Market Index Fund as well. Now, in terms of how you allocate your investments among those funds, that's something that depends on a few factors. So as a former financial advisor, what we always try to advise our previous clients to do was to assess our risk tolerance, our goals, and our time horizon for our investment. Now, based on those answers that they provide, we could actually come up with allocations that we felt confident in suggesting because it was tailored towards their needs. Now, if you are someone that doesn't know what their risk tolerance or their time horizon is, there are plenty of online questionnaires that you could fill out, and I'll link one down below so that you can kind of get a sense of what your investing strategy is going to be. So let's talk about some of the benefits of the 3-fund portfolio. The first is that it is simple. Because you are only buying 3 funds, it's going to encompass over 22,000 different securities worldwide in the stock and the bond market. And there's no overlap amongst all your investments, so you're getting exposure to a lot of holdings in the stock and the bond market. Investing can be really complicated if you make it so, but this 3-fund portfolio will make it pretty easy. I would even argue that the hardest part of having a 3-fund portfolio is rebalancing it every year, but I'm going to go over how to do that in this video anyway. The second benefit of having these 3 funds in your portfolio is that it's well diversified. Warren Buffett has once said that, quote, "Diversification is protection against ignorance. It makes little sense if you know what you're doing." And this is actually perfect for us average investors. Obviously, if we had Buffett's skill of investing, then maybe we could just pick a couple of stocks to go all into or put all of our eggs in one basket to, and they would perform really well because we were as knowledgeable as Warren Buffett. But the truth is that most of us aren't Warren Buffett. We don't study investing as a full-time job. So having these 3 funds is going to be well diversified and great for the average investor. Diversification here is really key to helping you not lose as much money as possible, because let's say we were in our previous example with Warren Buffett, you only had 3 stocks. If one of those 3 stocks goes out of business, then boom, you've just lost 33% of your total portfolio. If we're invested in an index fund that holds, let's say, 5,000 different stocks, if one of those stocks goes out of business, we're likely going to be fine. The third benefit of the 3-fund portfolio is that it costs very little. The average expense ratio of any of these funds in your 3-fund portfolio is going to be around 0.05% to 0.1%. That means for every $10,000 you have invested, every year you're only going to pay between $5 and $10 of fees on average. And fees are really important for your total returns. So the SEC actually has an investment bulletin that shows the effects of fees on your investment totals. So I want you guys to take a look at this graph. The following chart shows an investment portfolio with a 4% annual return over 20 years when the investment either has an ongoing fee of 0.25%, 0.5%, or 1%. Notice how the fees affect the investment portfolio over 20 years. In 20 years, a difference in just 0.25% of a fee can reduce your gains by $10,000 over the same period. If there's a difference of 0.75%, it could reduce your portfolio value by over $30,000. So yeah, we like the fact that this portfolio is going to cost us very little in fees. The fourth benefit is that there's no financial advisor risk. If you have your money invested with a financial advisor, they usually charge you a percent of all of your assets under management over the course of a year. The standard fee in the industry is to take 1% of your assets under management, or AUM. So let's say you had $1 million with your financial advisor. Every single year, you're paying your FA about $10,000 and fees just for helping you invest. And if all you're doing is investing with your financial advisor, you're not really getting the max value out of what they can provide. Similarly, there's no asset manager risk as well. So if you invest in an active mutual fund, they usually have to pay their fund manager because that person needs to live and have a salary. So oftentimes that will eat into your returns. But in this portfolio strategy, we're only investing in passive index funds that track the market. The fifth and the most important benefit of the 3-fund portfolio is that it never underperforms the market. Since it's tracking the broader market, you are putting your money into most of the stocks and bonds that exist in the world. And according to many studies, buying the market virtually means that you will outperform most active fund managers over a long period of time. Look at this chart that tracked the period of 2008 to 2016. We can see that there are many funds on this bar chart, but these are all hedge funds. And over a long period of time, you can see that the index fund outperformed all of them. So these are all the 3 benefits of the 3-fund portfolio. I hope that I've piqued your interest. We're going to get into exactly how to construct this now. The way we're going to do this is we're going to figure out what funds to buy depending on what brokerage you have. And then we're going to figure out the asset allocation that you're going to want, as well as how to rebalance this portfolio every single year. So here's the list of the funds that you're going to buy depending on your brokerage. I'll put them on the screen right now. In terms of the ETFs, you can buy these on any brokerage. So whether that's Fidelity, Robinhood, Schwab, or Webull, you can still create this portfolio. Now, in terms of the brokerages I definitely like Vanguard, I like Fidelity, and if you don't have a brokerage at all, you might want to try signing up to Webull. They're running a special promotion right now where they're giving away 7 to 12 free stocks as long as you deposit 1 cent. They aren't a sponsor, but if you do use the link down below, it will help support the channel, so I appreciate you guys for that in advance. But the exact ETFs that you are going to want are ticker symbol VTI, VXUS, and ticker symbol BND. Now, you can also see below that if you do have a respective brokerage open, there are specific index funds that you can buy as well. So with Vanguard, you can buy VTSAX, which is the total stock market index, VTIAX, which is the international market index fund, and VBTLX, which is their bond market index fund. For Fidelity, I've chosen the zero fee index funds. So that's going to be ticker symbol FZROX, ticker symbol FZILX, and ticker symbol FXNAX. For Schwab, we also have 3 index funds here, SWTSX, SWISX, and the last one, my favorite, SWAGX. You should be able to create a 3-fund portfolio depending on the brokerage that you're in. Now, some of the index funds will have minimum investment requirements. However, with ETFs, you can just buy those on the market and they do not require you to have any minimum investment. Now to choose an asset allocation. In simple terms, it just means that if you have 100% of a pie to invest, how much of that pie is going to go into stocks versus bonds? You could go with a portfolio that's mostly stocks or mostly bonds, depending on your risk tolerance. I would say if you are more aggressive or on the younger side, you want to lean more towards stocks because they're going to have more upside, but they're going to be more volatile. If you're more conservative or less aggressive, you're going to want to go with a portfolio with mostly bonds because they're less volatile. For the past couple years and up until recently, bonds were just not performing that well because the federal funds rate was close to 0. But since the Federal Reserve has been raising rates this year as well as into next year, bonds should return a lot better than they have in the past. So in this portfolio, you're going to want to have a mix of US stocks, international stocks, just to kind of balance out the US stocks, and then a bond fund to help you balance out the entire stock position of your portfolio. So let's actually look into some historical data and see how these different asset allocations perform. So there is actually someone on the Bogleheads blog that has been contributing to this every single year and updating it. So if we actually look at the results for the past 10 years, you can see that for the most part, the years are positive. In 2021, for example, a portfolio consisting of 80% stocks and 20% bonds would have yielded you 16.13%. You can see that across the board, most of the time, these are positive returns, but there are some years in which it is negative, and even this year in 2022, which it hasn't concluded yet, but it will likely be negative 15 to 20% just based on how the market's been performing. And this is something to note, not every single year is going to be a positive year for your portfolio. In fact, this is not a strategy that you're just gonna do for 6 months, a year, or even 2 years. This 3-fund portfolio strategy is one that you wanna have for 10, 20, or even 30 or more years. So here's another great chart from JP Morgan. You can see that on average, the stock market returns positively in most years. In fact, 32 out of the 42 years are positive. The average intra-year drop is about 14%. That means if you have $100,000 invested into the stock market, on average, there could be times when your investment balance goes down to $86,000. In some years, it's even worse than that. So in 2008, you could have been down to $51,000. And when you're looking at that and you're an emotional investor, that could be a very scary thing. But over the long term, the market usually bounces back, and that's why we don't want to just panic sell whenever the market is down, because over time we should prevail. Now, in terms of the most common asset allocations for the 3-fund portfolio, here are the 3 most common thanks to clevergirlfinance.com. An 80-20 portfolio will consist of 64% US stocks, 16% international stocks, and 20% bonds, and this would be considered aggressive. An equal portfolio would have 33, 33, 33, and a 20 to 80 portfolio would have 14% US stocks, 6% international stocks, and 80% bonds. Now you might be wondering, why don't we have our stock position 50-50 in terms of US stocks versus international stocks? And the reason is that having international stocks in your portfolio actually adds a little bit of complexity. There's currency considerations. In addition, a lot of international markets aren't as developed as the United States, and a lot of these international markets have governments that are a little bit too, I would say, overbearing. And that's why international stocks are considered more volatile, and this is merely a preference, but I'd rather have the US stock market over foreign ones, and that's why the asset allocations are as such. All right, let's talk about rebalancing and how to rebalance the 3-fund portfolio. Ideally, you are doing this once a year, and I actually haven't seen a video on YouTube that actually details exactly how to do it, so I'm gonna show you how. Let's say you have a 3-fund portfolio totaling $10,000, and you have an asset allocation of 33%, 33%, 33%, US stocks, international, and bonds. That would mean you have $3,333 in each of them. But over time, US stocks start to perform better. So let's say in this hypothetical scenario, your investment balance goes to $12,000, mostly driven to US stock returns, and your bonds and your international returns have stayed flat. Well, now your portfolio kind of looks like this. You will have $5,333 in US stocks, $3,333 in bonds, they've stayed flat, and $3,333 in international stocks. Well, now your US stocks in this certain scenario are worth 44.5% of your portfolio, and the other asset classes are worth 27.75% each. Now you're exposed to more US stocks, elevating your risk, so you want to get your portfolio back to an equilibrium of 33, 33, 33. So what we can actually do is to sell off some of our positions with the gains that we've made to make our portfolio a bit more even. If we go back to our example, since our portfolio is now worth $12,000, our 33% allocation would mean that we need to have $4,000 invested in US stocks, international stocks, and bonds. So what we would do is sell off $1,333 of US stocks and split that profit into the bonds and international funds to keep our portfolio in balance. Rebalancing doesn't mean you're withdrawing money from your investment portfolio, and if you do a rebalance within a tax advantage account like the 401k or even the Roth IRA, you might not even pay taxes on that until way later. The most important thing I also want to bring up in a 3-fund portfolio, or any portfolio for that matter, is that you should always be consistently investing. If you do so, you're freeing yourself from when the best time is to invest, and you're likely going to invest more and capture more upside overall in your portfolio over time. All right, guys, if you got any value out of this video, make sure to subscribe to my channel for more videos like these. Let me know in the comments what you think of the 3-fund portfolio, and make sure to check out Webull for those free stocks down below. I'm also going to leave a video up on the screen right now that shows you 6 different ways that I would invest $10,000, and that's going to be a really helpful video if you have some cash to deploy and you're not really too sure what to do with it. All right, guys, I'll catch you in the next video. Thanks for watching.